So stocks got whacked on Friday. S&P 500 went down like 3.37%. The Nasdaq went down like almost 4%. So was that expected? Absolutely. I told you guys in the last video that, stocks don't go up in a straight line. We will have a pullback after an overextension. So let's revisit the charts again and see where we are. So like I said in previous videos, I said, hey, this is a strong level of resistance that prices were coming up towards, right? At the same time, it is also coinciding with the 200 moving average resistance. So sure enough, we hit that resistance, we pull back from resistance, and we see another strong level of support and resistance over here at 4158. So we pulled back down, and for a brief moment, it looked like we kind of like found support at that level and we're bouncing back up. But then on Friday, there was a speech by the Fed Chairman, Jay Powell, and that was the trigger that caused the market to drop significantly on Friday. So those of you who understand technical analysis, what do you see, right? You see what is known as a bearish engulfing pattern, which is a bearish reversal pattern, if you understand candlesticks. And this happened at a significant level of resistance and support, right? So based on price action, safe to assume there's a high chance the market is going to go back down for the short term, at least towards that 50 moving average and maybe even below that, right? So because of that, I went short again on the market. I added to short positions by buying bear put spreads on the SPY ETF. So I'll just show you, if you look at the SPY, this is the S&P 500 ETF. And so what happened was I bought puts at the 410 strike price, and I sold some puts at the 395 strike price, creating a bear put spread. And those of you on my notification channel, the UIP notification channel and the options Iron Striker chat group, this was the alert I gave the moment I entered a trade on the 26th of August, which was Friday, just when the market, at the beginning of the Powell speech, actually, right? So I said, hey, you know what? It looks like we are going down to the 50 moving average. I said, hey, I'm now entering a bear put spread, buying the 410 put, selling the 395 puts. And of course, I added more to the positions later during the day. So essentially what's happening is that I'm short the market for now and hoping the market is going to go down and I can make some good profits as the market goes down. Now, some people who watch my video may get a bit confused, but Adam, I thought you are bullish. Why are you now bearish? I thought you're bullish. I'm confused, right? So what you got to understand is that you have to separate short-term, medium-term, and long-term, all right? So short-term, I'm bearish based on the price action, and also based on the fact that I told you that after a wave up, you got to have a wave down. And also we're going through the seasonally bearish months of September and October, where the market tends to be more bearish before a strong rally in November, December. So short term, in the next 1 or 2 months, I'm bearish, all right? And that's why I'm shorting the S&P using options. And of course, how low it'll go, I don't know. No one can predict exactly how low it's going to go. But as I said in my previous videos, I believe that this particular bear market has already bottomed, right? The 15th of June, or was it 16th of June, that was likely the bottom of this bear market. But it doesn't mean that the bear market is over, right? We are still in the bear market and we don't have a bull market yet. But what I just said was likely the bear market is bottom based on what I'm reading in the macro fundamentals and the fundamentals of businesses. And I'll explain more about that later on, okay? So again, short term, bearish based on price action. But medium term, in the next 6 to 12 months, I'm of course bullish, right? Because the economy is doing very well. The labor market is very strong. Corporate earnings have been better than expected. In fact, profit margins, right? Corporate profit margins are the highest they've been since 1950. So companies are doing very well. Economy is doing really well. And the only thing that's pulling it down in the short term is, of course, this fear of high inflation and the Fed really tightening monetary policy. We'll talk more about that later on, right? So again, short term bearish. Medium term, 6 to 12 months, I'm bullish. I think we're going to end up, like I said, at all-time highs by end of the year or next year. Long term, I'm always bullish, all right? Because in a long term, 5 to 10 years, market always goes up. Remember that, okay? So again, the fact that the market is pulling back down now, is that good or bad news? I always believe that in life, there's no such thing as something that's good or bad, right? It's your reaction to it, how you respond, how you react to it. So it's not the event that determines your outcome, it's how you respond to the event. So to me, everything is good news. Market goes up, good news. Market goes down, good news, right? I go with the flow. So when a market goes down, it's good as a trader because you short the market, you make money as it goes down. So as a trader, you don't really care where it goes, right? As an investor, if you're buying great companies or you're buying ETFs, when the market goes down, it's great news as well because it gives you a chance to, add more shares before it eventually goes up in the long run. So I tell my students who are investing, it's kind of like those of you who felt that the bus went up too fast, the bus is now turning back to pick up more passengers, right? So you get more passengers on the bus before it goes back up again, right? So in the meantime, use the chance, the weakness to add shares of great companies or of index ETF. So again, for me, in my trading portfolio, I'm shorting the market, right? But in my investment portfolio, I'm buying stocks, right? So you got to know, again, the difference of whether, it's an investment strategy or trading, and you got to learn how to combine both to succeed in the markets. A lot of people, they will blame Fed Chair Powell, because he opened his stupid mouth because of what he said. That's why the market went down, the bastard. Now, I look at it pretty differently. To me, I don't believe that events cause the market to move. It is how people respond to the event that moves the market. And to me, whether or not Powell said something or someone else said something, the market was going down anyway. Why? Because of the technical setup. Like I said, we hit a level of resistance. The market was overextended. We're going towards the September-October period, which is bearish. So the market needed an excuse to go down. So whatever happened, the market always finds, that's the excuse and let's go down right now. So market makers tend to manipulate the markets to kind of like shake out the weak hands so that the weak hands, the paper hands get blown out of the market, pushed from the market, and then the market makers and the institutions will drive up stock prices again. So always remember that the market always finds an excuse to do what it already wants to do. Now, but let's focus on what Fed Chair Powell said. And why did what he say so-called have a reaction to the markets, okay? And what has changed? Has anything fundamentally changed before Friday? And I'm going to show you that the answer is no, nothing really changed. If anything, financial conditions are actually getting a bit looser. So let's analyze what Powell really said on Friday. The main gist of what he said was that we are going to do whatever it takes to bring inflation down back to 2%, and we're not going to back off anytime soon. We're going to continue to raise interest rates and keep them high for some time, and some of you will suffer. I don't care. We need to have some short-term pain for long-term pleasure. Essentially, that's what he said, right? Now, this was actually some of the points of his speech. He said that reducing inflation is likely to require a sustained period of below trend growth. So what he's saying is that in the short term, I'm going to sacrifice growth in order to bring down inflation. So I'm going to cause the economy to slow down. I'm going to cause corporate earnings to slow down. And of course, people get freaked out. Oh my God, the growth is slowing down. We're going to die. And they sell off the growth stocks and they all collapse, right? Now, again, as an investor, am I concerned? Of course not, because I know that these companies will grow over the long run. So if the Fed wants to artificially push growth down in the short term, it doesn't matter. It gives us a chance to buy more shares before it resumes its growth trajectory again. And then he says, moreover, there'll be very likely to be some softening of labor market conditions. So what he's saying is that the labor market is now too strong. The jobs market is too good. Unemployment rates are too high. In fact, he said that the labor market is very strong and is out of balance, with demand for workers substantially exceeding the supply of available workers. In other words, there are too many jobs and not enough people to fill the jobs. So he's saying unemployment is too low. I don't mind increasing unemployment to get people to go back to work, the lazy bastards, right? Give them some pain, crash their crypto, crash their Bitcoin, so they're going to go back to work. Essentially, that's what he's saying. So he's gonna want to bring down or bring up the unemployment rate. Of people freak out. Oh my God, unemployment! We're going to recession. I'm going to die, and they freak out, right? And he said, well, higher interest rates will slow growth and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. No shit, Sherlock, all right? These are the unfortunate cause of reducing inflation, but a failure to restore price stability will mean far greater pain in the future. So he reminds me of Clubber Lang from Rocky III. And when they asked Clubber Lang, what's your prediction? He said, pain. Right? So when people said, oh my God, we're going to die, pain, and they freak out. And that's why, the market tended to freak out, and that's what caused that reactionary drop on Friday. So Fed Chair Powell is like the father, and the stock market is like his daughter. Now, he loves his daughter. He wants his daughter to succeed, obviously, but he feels that his daughter is having too much fun right now. She's too high, she's partying too much. He's afraid she may overdose or she may flunk her exams and drop off college. So he threatened her on Friday. You know what? I'm going to take away your phone and cut your allowance. And so the daughter was obviously not happy, in a bad mood, and that's why the stock market dropped. Now, the interesting thing is, if you watch the bond market is basically saying, bullshit, Mr. Powell, I'm calling your bullshit. You're not going to raise rates even more. You're not going to do more than what you've already said. You're just talking tough. You're not going to follow through. So what do I say there? Now, let me show you something interesting. After Powell's speech, you would expect that the 10-year Treasury yield would go up a lot, right? And the 2-year yield would go up a lot in expectation of higher Fed funds rates. But they didn't really go up that much. In fact, if you take a look at the 10-year yield, the US government 10-year yield, what happened on Friday? It did not go up. It stayed where it was. Okay? And if you look at the 2-year Treasury yield, yes, it went up, but only slightly to 3.4%. Now, what does this really mean? This means that the market expects that interest rates will be at 3.4% in 2 years. Now, currently, the Fed funds rate is 2.25 to 2.5%. Before the Friday speech, the market expected the Fed to raise interest rates by another 1% to 1.25%, which means raise interest rates to 3.5%. This was before the speech, right? Now, after his speech, you would expect that the market would price in a higher rise in long-term interest rates, because he said, I'm going to raise interest rates even more. But it didn't, all right? The 10-year yield remained the same, and the 2-year yield is now only at 3.4%, which is lower than 3.5%. So basically, if you look at the bond market is calling his bluff and say, yeah, bullshit, you're talking tough to scare your daughter, but you're not going to take away her allowance, you're not going to take away her phone. We know that. Now, here is more proof that the bond market realizes that Powell was just talking tough to threaten the daughter, but he was not really going to raise rates more than what's expected. And this is the Fed Watch tool. So you can see that before his speech, there was a 45% probability of a 50 basis points interest rate increase next month in September, which is 0.5%, higher than the 36% probability on Thursday. At the same time, the probability of a 75 basis point hike was at 54%, down from 64% a day prior. So what does this mean? So before his speech, the market was kind of like guessing, is he going to raise interest rates by 75 basis points or 50 basis points, right? So 75 is more aggressive, 50 basis points is less aggressive. Before his speech, there was a higher probability that they're going for a 75 basis points, which is over here, right? So before the speech, there was there we go, 1 day before, 64% chance of a 75 basis points hike in September. After the speech, it didn't go up. It went down to 56%. And the market, from believing that he's going to raise interest rates by 50 basis points from 36%, it now went up to 43%. So this is something really weird. In other words, after the speech, the bond market and the market in general is expecting that he's going to be less aggressive than more aggressive. So why is there a difference from what he said to what the market believes? Because like I said, the market realizes that inflation has actually peaked and the drivers of inflation have all but dissipated. So they realize that the only reason he talked tough was to kind of like get the market to come down temporarily because it was going up too fast. He was afraid the market goes up too fast, it will reignite inflation. All right. So he did that to purposely pull the market down in the short term. But nothing has really changed in the actual Fed policy. The facts remain the same. Like I keep saying, before Friday, after Friday, nothing changed. The facts are the same. And the reason the market believes that the Fed doesn't have to increase tightening more than they've already said is because inflation is actually coming in better than expected. It's decelerating, right? On Friday, if you take a look at the core PCE, which is the main indicator which the Fed looks at, it came in at a 4.6% interest rate, a 4.6% rate, which is the inflation rate in July, which is lower than the 4.7% expected. So inflation, current inflation data is continuing to moderate, but the Fed says we want to make sure there's a clear trend and not just a short-term moderation. If you take a look at the 5-year break-even inflation rate, it continues to be on this downtrend pattern, although you can see it ticked up a bit slightly. So I think that is what concerned the Fed, and so they want to talk tough to make sure that it remains down and it doesn't go back up again. Now, if you take a look at the drivers of inflation, the good news is this: if you take a look at what has been driving inflation in the last 2 years, it has dissipated. It has all but dissipated. So what has been driving inflation? Number one, oil prices, right? Oil prices have been driving up inflation, but oil prices have been going down. You can see crude oil prices in that downtrend pattern and still remains below the 200 moving average. US housing has been a second driver of inflation, with home prices going up, demand exceeding supply, but now it has completely reversed. US housing demand has been declining. New home sales have dropped to about minus 35%, which is the biggest drop in home prices since the great financial crisis. And that's what's freaking some people out, say, oh my God, home prices are collapsing. Are we going to have another great financial crisis in 2008? No, it's a totally different situation. At that time, a lot of the homeowners, they were on adjustable rate mortgages. Many of them had no income or no jobs and couldn't pay their mortgages. In today's environment, homeowners are mostly on fixed rate mortgages. They have got jobs, they've got income to pay their mortgages. Back in 2008, banks were highly leveraged with all these toxic mortgage assets, but today banks have much lower leverage. So in other words, there's no systemic risk in the financial system as there was in 2008. So even if home prices continue to fall, yes, there could be a recession, all right, but there will not be kind of like a major financial crisis of 2008, 2009. That was a completely different story. I know, because I lived through that, okay? Now, the third thing that was driving inflation was, of course, supply chain disruptions from the Ukraine war and from China's COVID-0 policy. So all that supply chain disruptions causing delays in shipping and in logistics caused prices to go up. The good news is supply chains have been easing significantly. If you take a look at these two charts, for example, all right, you can see the Oxford US Supply Strain Index has been falling for 3 straight months up to June, and in fact, July, August, it has fallen as well. So in other words, the strain on supply chains are easing. The second part is if you look at ocean shipping rates. Now, shipping rates are one of the main indicators of supply chain disruptions, right? And when there were disruptions, freight rates went up. But now, shipping rates have fallen dramatically and are in fact in a bear market. Now, at the same time, China, which is involved in a lot of supply chain and logistics globally, they'll be having their November CCP Party Congress, which is the Communist Chinese Party Congress in November. And there's a high chance that after the Congress, they will lift their zero COVID policy. Now, how do I know that? Because I've got a lot of spies in China, right? So that's good news. So the moment they lift the COVID-0 policy, the high chance, then supply chain problems would basically all go away and inflation will continue to go down. So everything is moving in that right direction. So bottom line, the Fed loves the stock market and loves the economy, loves America. They want the economy, the stock market to succeed. But in the short term, it's partying too much, it's having too much fun, and that could screw up their inflation agenda. And that's why Powell needs to talk tough to bring the market down in the short term. So again, short term, I'm bearish. I've taken short positions in the S&P and some stocks. But of course, in the medium term, in 6 to 12 months, I believe that stocks will be a lot higher. Why? Because the underlying economy is strong. And yes, although the Fed wants to raise unemployment a bit, by a bit, they want to slow down housing. It will cause a mild recession. It may cause a recession, but it doesn't matter. We will not get the kind of crash in 2008 or 2001 because the economy is a lot stronger. Corporate balance sheets are stronger. Companies have record high profit margins. And again, if you hold on to great companies with pricing power, with solid balance sheet, with huge amounts of free cash flow, they will do really, really well. And as always, avoid companies that are speculative, that are losing money and are only driven up by hype and cheap money, because those are the ones that collapse and they will never come back. So stick to good companies or simply stick to the index ETF, average in when you see a pullback and you'll do very, very well. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.